This is Make Money Count, brought to you by Connect Home Financing. I asked during the last show a question that I can't remember if it was my question or a text question, but it was a question that I honestly didn't know the answer to. I assumed the answer and I completely assumed wrong. So I want to talk about it a little bit more this week if we can, because I think there's probably a lot of people don't understand the difference. That is, when it comes to mortgage, the difference between refinancing and renewing. Because to be blunt, before the show last week, I would have assumed that they're both the same thing. And you said they're absolutely not, and it could be a very costly mistake.
Okay, so it's not that they're absolutely not the same thing. They're pretty similar. Refinance just implies that you're going to affect some change on that mortgage, and very likely that change is going to happen prior to the maturity date of the loan. A renewal just means that it's your mortgage is coming up for renewal on a specific date, and you're going to negotiate on that date, or hopefully as far in advance as possible with a broker like Connect on your side. But you're going to negotiate as far in advance as you can to make sure on the date of your renewal, your mortgage moves from one lender to another lender as absolutely cheaply as possible. Because like we've spoken about many times, there are so many lenders out there that will pay legal fees and transfer costs and a portion towards the administration costs. Like, it's a really, really good time to switch on a renewal. But what the easiest thing to do is to stay with your existing lender and use the tools that are afforded to you naturally on websites and different information that you can glean from friends and family members as to what the best rates are out there. And a broker will help you negotiate with your bank. So, the first option is, if you don't need any more money, do your best to hammer down your bank or your existing lender to the lowest possible rate with the help of a broker. And if that isn't the lowest rate available, know that you've got tons of other options out there that are available to you. A refinance is a little different. A refinance typically means you are going to pull out equity. And we're going to talk a little bit about that on today's show. Refinancing your home means that you've weighed the options. You've weighed the negatives associated with refinance. And the most common negative is that you're going to have a penalty to break your mortgage. If you're breaking your mortgage, if you're switching to another mortgage prior to the maturity of your existing mortgage, even if it's with your existing lender, you're always going to find that there's a penalty. The cheapest penalties are for people that have variable rate mortgages. Those are almost always, the penalty in that case is 3 months of interest. So not 3 months of your mortgage payment, but more like 1.5 months of your mortgage payment. And right now, the current climate that we're in, with really low interest rates, which we're going to talk about also today, because interest rates, the bond yields we spoke about last week and the week before, have gone up. I still don't think it's time to rush into locking in, again, depending on who you are. And I'll give you a quick reason why. The Atlanta Fed, in the United States, in Canada, we have one central bank, the Bank of Canada. In the United States, they have the Federal Reserve, and then each state has a Federal Reserve. So the Atlanta Federal Reserve produced a report where they analyzed the amount of ancillary stimulus that had been pushed into the economy, and they tried to compare it to how potent an interest rate decrease would have to be to mimic the effect of that stimulus that was injected. And I'll unpack this a little bit. So in the United States, just like in Canada, when COVID hit, interest rates were low, and they made them even lower, right? Like, we saw interest rates go to effectively zero in both countries, maybe 0.25 in Canada, zero in the United States. That's the overnight rate. So the rate that the central bank sets, and upon which all other rates are built. So like the LIBOR, London interbank overnight rate, the prime rate, which is what we cite most often here. All these things are priced off of the overnight rate. So what the Atlanta Fed said was, in addition to dropping interest rates, or the overnight rate that the central bank sets, to effectively zero, we know that the Federal Reserve and the Bank of Canada both, although the Atlanta Fed doesn't care about what the Bank of Canada does, but we know that both of these central banks, and frankly, all the central banks around the world, engaged in other practices. Those practices are typically called quantitative easing. They are the buying of mortgages, the buying of securities now, the buying of bonds. The idea being to inject liquidity into the financial system at a time when the financial system is seizing up because of a lack of trust and a lack of propensity to take on risk in the part of the investors. So what the Atlanta Fed said was, all of that quantitative easing that we saw over that period of time, if we couldn't have engaged in it, how much would we have had to drop interest rates instead to stimulate the economy?
Mm-hmm.
Do you want to guess how much of an interest rate drop, where interest rates would have had to have gone to in order to replicate the free money that was handed out, the buying of bonds, the buying of securities, the buying of mortgages, the massive financial undertaking that the Trump administration took on? How much would they have had to drop interest rates in order to receive the same effect? Just shoot out
Justin, do you know?
2%.
Did you know that? Did I tell you that?
No.
Yeah, 100%, 2%. So
Wow.
interest rates would have had to go to minus 2%. Now, this is a little bit of a long way to get to something, but what I want you to focus on right now is that information is very recently released. Market still hasn't digested that, I suspect. But for us right now, listening to central bankers telling us that inflation is transitory and that they will be slow to increase interest rates, you better believe that they understand how much they've decreased, artificially dropped interest rates below zero. So when we're talking to clients about locking into a rate, understand that the effect of pulling back almost 200 basis points of interest rate stimulus, which is going to happen. Bank of Canada announced it. Federal Reserve announced it. They're going to pull back on all that stimulus. We're going to see, before the Bank of Canada announces that interest rates are going to rise by 25 basis points, we're going to see them remove 200 basis points of stimulus. That will have an effect on our economy.
As I said, let's get right to the lines, because if you do call in, we don't want to leave you waiting at 416-872-1010. Sarah did just that. Good afternoon, Sarah. Welcome in.
Hi, thanks for taking my call. I need to renew my mortgage, and my bank has insisted on me to come in to discuss it, so I did. And when I got there, they gave me 2.34 for a fixed rate, which I'm pretty sure is not that great of a rate from what I've been hearing. And without me knowing, they also brought a financial advisor into the room to talk to me as well. And I felt a little bit bombarded, but I was also considering to pull some equity out of my home to invest. So I was wondering if that's something that you guys could just do, all of that, because I got a really bad feeling about my last encounter with my bank.
Okay. Well, Sarah, thank you for the call. I don't really know what's a good 5-year fixed rate, Justin.
This is a bad time to ask me because everything just changed.
All right.
But if you're coming up for renewal, I know that for definite, if we're looking to transfer the balance of your mortgage, we can definitely do better than that. I can get back to you in a moment.
Yeah, I mean, you would hope that you would know that for Sarah's sake.
It's a volatile. If it's a volatile rate market, right?
I mean,
now.
it's really not that complicated. I know that we're sub 2%. I know we can get you something sub 2%. So we'll start there. So it is weird lately. We've been hearing more stories about customers going into their banks and being cross-sold products. And there's a kind of fine line in it. We know that the government of Canada doesn't like it when banks cross-sell and tide sell financial products. But the fact that you got pulled into a meeting and there was a financial advisor there probably means that you have some equity in your home and you're a good customer of the bank. And if you've listened to some of our last shows, I think it was 2 shows ago, where we went through a report that the Bank of Canada had that essentially said the more products you have with one bank, the worse the rates you get on all those products are, because they see your loyalty. So it's not a great idea to invest where you borrow unless you see a really, really direct benefit. You've got to leverage that. With Cannect, we could definitely help. I know that on the one side, we can help you get the best rate possible on your mortgage because that's all we do. And if you went on our website, it would show you immediately what products you qualify for. So just answer a few questions and it'll spit out all of the best options available to you, whether those be fixed or variable and varying terms. There's a total automation. Alternatively, you could call in and speak to someone, ideally not Justin, who doesn't know what the fixed rate is today, and they can help you.
God.
I have the rates now.
But
Depending on what kind of features you want on your mortgage, it's 1.78 is the lowest we can get you right now.
There you go. So like compared to the 234 that Sarah was offered, that is a significant discount.
100%.
Right?
Well, and I have to get a babysitter to go to the bank. Meet them in person on top of that.
You or for your kids? Just kidding, Sarah. Just kidding. No, honestly, that's crazy. So, and then on the other side, on the investment side, we've spoken about this before. Depending on what bank it is, banks want to sell you their products. And the most commonly sold products at the bank are their mutual fund products. Their, RBC Fund 1, Canadian equities or global equities. And each of these funds have different classed tiers based on how successful the financial advisor is at selling you the product. So if the financial advisor thinks you're a sucker, you'll get a class F share, which means that the bank will pay you all of the return less 5% that they'll keep as a fee. And then you might negotiate a little harder and they might give you a class C share where the bank will only take 4% or 3%. But this is just to say that we talk about how the banks game us in mortgages. They're doing the exact same thing in insurance and investments. Mm-hmm. So just the more information you have, the better off you are. And then I can tell you that Cannect has a mortgage fund, which all of us here are invested in, which we have, maybe close to, I don't know, not 1,000, but pretty close to 1,000 investors in. Small investors, big investors. And Cannect returns about 8%. And Cannect returns that, we've returned that over the last 10 years. I got to say, future performance is not, or past performance is not indicative of future performance. But for the last 10 years, our average is 8%. And it's 8% for everybody that's invested. It's not 7% for some people and 6% for some people and 9% for other people. It's just 8. It's just about 8% every month. We do our best to return about 8% every month without taking on too much risk. Never had a loss in our portfolio. That's not indicative of what could happen in the future, but we're all invested in it. We think it's pretty amazing. And we think that the reason why we have such success in that fund is because our staff, like our salaried trained staff, are looking for the best borrowers. And the best borrower means someone who's listening to this show today who lost their job or whose credit sucks because they were sick or who, for whatever reason, needs some help. And we figure out how we can use the money that we're entrusted with to help somebody. And when you do that, you match the motivation of you, the investor, hopefully one day, Sarah, us, the broker, and our borrower. And if everyone's motivation matches, cool stuff happens.
John is in Aurora. John, good afternoon. Thanks for calling.
Hi, good afternoon, sir. My question is, I have 5 years lost my mortgage like 3 years ago. It's left 2 years. How much I have to pay a penalty when I break it now?
John, what's the interest rate on your mortgage?
I think it's almost 3%.
Who is your mortgage with?
Royal Bank.
Okay, so it's going to be high. What's the loan amount?
How much balance is?
Yeah, the balance, yeah.
Yeah, I have 500.
Okay. Yeah, like anybody that's in a mortgage right now that's, over 2.5% should, in a fixed product should really consider I mean, speaking to someone at Cannect about their options, especially if they're looking to take equity out. And I don't even know that it needs to be a fixed rate. Like the one thing that we talk about a lot is variable rates are so cheap right now. And if you get a variable rate mortgage with the right lender, not a bank, you can lock into a fixed rate in a minute, right? It's a same day lock in. So if you're a Connect borrower, if we get you into a variable rate product, every week you're informed as to what's happening with interest rates. Your mortgage is being monitored by us, and you're given information that will help you decide whether or not you should be locking in order to protect yourself against a rise in interest rates. So use that. Use the information that we provide you with to stay ahead of interest rate moves so that you can, and that I just explained that, if you have a 3-year mortgage and you lock in today at a 5-year fixed rate, so if you have 2 years left on your mortgage and you lock in today into a 5-year rate, you get an extra 3 years at the low rate. But if you can ride a variable rate mortgage for the next couple of years and then lock into that 5-year rate before rates spike, that gives you even more runway on the back end of it as interest rates are rising. And at the start of the show, we spoke a little bit about that stimulus that's being removed, the quantitative easing that the central banks are pulling out of the market. I think that might afford the Canadian consumer and borrowers around the world a little more time and runway that we may think we have, so that a variable rate might make more sense than we initially believe by simply monitoring bond yields right now. Bond yields move every single minute of every single day, and they move in correlation to how strong or weak people perceive the economy to be. So use the information that we've been, like, Connect has been created to provide unbiased information to borrowers. And whether you are an existing client or a client to be, use that information.
I also just want to step in here and just say, like, in a situation right now, just because if you water it down, the penalty that you're paying to break your fixed rate, if rates are higher, is going to naturally be a little lower. So in a market right now where rates are a little volatile,
good point.
Yeah, we can also, we can lock you into a rate right now and hold that commitment for 120 days. And in the next 120 days, we'll watch bond yields. And when the bank rate goes up, that will be the time that you should be breaking your mortgage. So we can take a look at also, saving you some cash there and making sure that you are breaking your mortgage at the right time to take the most advantage of these, volatile interest rates.
So well said. So just to put a finer point on it, bond yields go up and then mortgage rates go up. Mortgage rates go up, mortgage penalties come down. So you can use that information. We know that, if bond yields go up, and they did go up last week, it's very likely that the Royal Bank will increase their 3-year posted rate, or in your case, their 2-year posted rate. The higher that 2-year posted rate goes, the lower your penalty goes, because your penalty is calculated essentially as the difference between the rate that you have and the rate on a term that most closely matches the time remaining you have on your mortgage. So if the difference between those two rates tightens, your penalty goes down. Cool.
Justin, one of the things that Mark has pointed out, and I think it's worth noting, is, the risk that people take when they just go to the bank and look at whatever the posted numbers are there. Because as he was explaining to John, there's so many variables. When someone picks up the phone, gives you guys a call, there are so many other variables that can go into finding the right fix for them, as opposed to them, just hopping on the local bank site to see what the mortgage rates are.
For sure. So when I quoted, I think it was Sarah, the rate earlier, I had mentioned, depending on what kind of features you are looking for, this is the rate, right? So Do you make commissions? Are you paid in lump sums over the year? Do you want to prepay your mortgage? You know, what is your time horizon? There's so many things to take a look at rather than just applying for a mortgage, right? And picking the right broker who is going to ask you these questions and make sure that you're getting the product that's built for you is very important.
One more thing also, John. The worst place to ask what your mortgage penalty is at your bank.
Yeah.
Because they're not obligated to help you reduce that penalty. In fact, they're obligated to make sure you pay the absolute maximum amount to break that mortgage. They're not going to tell you things like, well, you can reduce your penalty by 20% by utilizing the prepayment privilege that you naturally have in your mortgage.
Mm-hmm.
Or, listen, you got to check the math. You're responsible for your mortgage. So let Cannect help. For starters, we'll just check the math for you.
Guys, I know, you know what, we play around a lot and have some fun on the show. One of the more serious things, though, that we probably don't talk about enough is the podcast that you do. When I'm traveling back and forth, I usually load up on podcasts. I don't drive, so it's just sitting there, passing time. And I did catch, it's a lot of what we're talking about today. And if people aren't subscribed to the podcast, they should. And it was the How to Beat the Banks at Their Own Game episode, which had a ton of great tips in it.
Yeah. Again, it all comes down to information, right? So understanding what the banks are motivated by, which is making the most amount of money on you as possible, and figuring out ways to use that to your advantage. So, we spoke to John, that last caller, and explained that you can't go to your bank to expect to get a fair shake on what your penalty is going to be.
No.
You also, before you negotiate something with your bank, you should know what their bottom line is. There's a lot of really good tips and tricks in that episode and a ton of those other episodes. I don't know how many podcasts we have so far banked in that, but
I think you're up to 25 or 26. Yeah.
Matt was saying recently that we were like the number 3 business podcast or something in Canada for, I think it might just be for podcasts that start with make and the last word is count with money in the middle. But I think that we might be gaining a little bit of traction here. Probably
it is worth signing up for. Whatever you do your podcast with, look up the Make Money Count podcast. I want to get to the lines if I can. There we go. Let's do that. Let's check in with where are we going to go? Let's go to Lawrence in Mississauga. Thanks for holding, Lawrence. What's your question?
Hey, guys. I'm playing with the idea of getting a rental property, like a duplex or something, for some passive income down the line. And actually, I want to do this 5 years ago, and I wish I did, because houses are like twice as expensive now. The thing is, I do already own my own house. Has a variable rate mortgage, and I'm told that's pretty easy to break. And has, I think, about $450,000 left on it, and the house is probably worth around $950,000. So the thing is, my buddy does the same thing. He has a bunch of properties, and he warned me rentals are a major pain in the you-know-what when we're dealing with the bank. So I'm just wondering, is there anything you can tell me, any advice, just to make things easier and as simple as possible? Because I don't need any more headaches.
Sure. So first off, 950,000, 80% loan to value, Justin.
720,
60, 760.
760.
Yeah, $760,000 of available capital, $450,000 first mortgage. 310. Yeah. So you got $310,000 available to you, depending on income qualification that you can use to put towards a down payment. The problem is every bank has a different way of considering the rental income on the property that you're buying. And I mean, I'll tell you, number one, banks aren't crazy about you taking out a ton of equity. Without a good kind of place to store it and put it. Although, listen, buying another rental property is a good idea. Asset prices are high because interest rates are low. And you are not the first person to have the idea to buy a rental property. You won't be the last one either. But it should make you careful. I think that interest rates are low. I think that we've talked about the amount of stimulus that is in the economy. We know that some of that's going to get pulled back, but the central banks are very, very aware of not pulling too much of it back. Asset prices are at all-time highs. And if you look at what the pundits are saying about the stock market, that can reflect on the property and real estate market. If inflation's coming into the marketplace, like we're being told and like we can see in the price of goods, it's going to inflate all asset prices, including real estate. There's some stuff coming out of the United States where they're judging how much more people are paying to rent and live, and how much of an effect that's having on inflation numbers also. So I think that if you do this properly, buy smart, buy the right type of real estate, and buy it for a long term, this could really work out to your favor. Again, like, you're saying you want to buy a rental property. You're not trying to flip something. So inherently in that, you have a little bit of a longer time horizon. So I would say, again, it sounds like a broken record, but let's look at how much you can borrow on your existing home. Let's look at what you qualify for. And then let's look at the types of real estate that you're looking to purchase. And, maybe it's a rent, like if I just off the cuff right now, if I was in your shoes and I was looking at a rental property, I'd want something that needed some work. I'd want something that you could kind of sprinkle a little bit of magic on to see that you could lift the value of that property. And that will insulate you a little bit from a market that, has gone up a lot in the last 20 years. That being said, as the market goes up, rents are going up. A lot of the expenses associated with fixing it are going up also. So let's be smart about how we do it. And Cannect, again, I want to harp on this. We're not real estate agents, and we don't make, like, whoever you're speaking to on the phone doesn't make any more or less money whether you do a mortgage or you don't do a mortgage with us. So you're going to get unbiased advice. And a lot of the people that you're going to speak to here have their own rental properties and can help you run analysis on, what you should be buying and what you shouldn't be buying. So listen, it's a broad answer, but there's a lot of details I'd want to consider before saying, point blank, yes or no, what you should be doing.
I've only got a minute left here, guys, and I want to get this question in from Michael and Vaughn. Good afternoon. Welcome in. What's your question? Michael? Okay, he's got a question about your fees. He says he's very wary of mortgage brokers. Just about 45 seconds. Can you talk about fees?
Okay, so listen, there's no fees. If you are getting a residential mortgage from Cannect, there is no fee. We are discounting the rate as much as we can possibly discount it to make sure you get the best rate. Your best rate now and forever at Cannect. That's what the name is. And as far as our second mortgages, home equity loans, third mortgages, equity-based products, the fees are totally transparent. You go on our website, you click on borrow, you look for a Cannect Flex loan, you type in your property information, our automated system pulls in all of the details and prices your loan for you in real time and tells you the fees. There is no gamesmanship here. This is the best product you're ever going to get, and it's from the best company. Cannect.